So again, this is Andy Umbach with Pulse Financial Services, certified financial planner, chartered financial consultant, retirement income, chartered professional, which is what all those designations are. So, and I'm happy to provide you the economic and market updates for first quarter of 2024. At the start of last year, many investors and economists were worried that 2023 would be a challenging year for the economy and the markets. Instead, 2023 turned out to be a year of surprising resilience. Growth accelerated to 5.2% during the third quarter, while inflation has continued to slide towards the Fed's 2% target. Looking ahead, the economy should slow in 2024, but a soft landing still looks possible. However, with fading tailwinds from the consumer and business spending, slow momentum does leave the economy vulnerable to any kind of shock. Meanwhile, hikes, after Fed hikes in rates hikes by a cumulative 5.25% points over the last 2 years, the last of the Fed's rate hikes is likely behind us. At its December meeting, the Fed kept rates unchanged, and forward guidance indicated that rates are at their peak. That said, the Fed is still firmly pushing back against any notion of early rate cuts, raising the risk that rates will stay higher for longer. Ultimately, this will depend on whether or not the U.S. economy falls into a recession. Despite Fed tightening, equity markets saw impressive gains last year with relatively low volatility. The same cannot be said for bond markets, however, which grappled with elevated interest rate volatility and supply imbalances. As investors look forward to 2024, geopolitical uncertainty remains elevated. However, valuations outside of the largest stocks look attractive. Fixed income offers strong asymmetric returns, and investors can look outside of public markets to alternatives to help fine-tune portfolios for desired outcomes in alpha, diversification, and income. 2024 could be another year of surprises, but leaning into active management and stepping out of cash should help investors take advantage of the changing investment climate. The Guide to the Markets, now in its 20th year, is constructed to try to address these kinds of questions. However, it is important to do so concisely. Really, there are over 60 pages to the guide, but it's far too many for any conversation about the markets. So what we do here is we boil it down to just like 11 slides. In particular, we assess the performance of this past year for the markets and economy, considering trends in growth, jobs, and inflation in the U.S., and how these trends are shaping the outlook for monetary policy. This is followed by comments on growth from around the globe. And finally, we consider the implications of all this for those investing across asset classes and highlight the importance of stepping out of cash and actively engaging with opportunities in alternative assets. The U.S. economy saw impressive resilience last year, with the first 3 quarters showing above-trend real GDP growth. Easing inflation and improved prospects for growth have helped fuel optimism for a soft landing. However, a quick look across each sector of the economy tells us that the economic momentum in the year ahead is set to be moderate at best. Business spending held up better than expected last year despite tighter lending standards, supported by increased spending on intellectual property with greater emphasis on building and integrating artificial intelligence capabilities. Tailwinds from AI spending, as well as federal government support for semiconductor manufacturing, should persist into 2024. However, increased caution among lenders and slowing corporate profits could still constrain growth in capital expenditures. The consumers have remained resilient, supported by a tight labor market and rising real wages. That said, there are some signs of weakness. While revolving credit as a share of disposable income does not look overextended, delinquencies are rising, and younger households are showing signs of increased financial stress. As labor market conditions continue to loosen and lending standards remain tight, consumer spending should grow at a slower pace from here. The housing market appears to have stabilized, albeit at low levels, as tight housing supply and steadying mortgage rates are signaling that the worst is behind us. Trade should be a mild drag on the economy as a still strong dollar and sluggish global growth weigh on exports. Meanwhile, government spending growth should slow as gridlock in Washington limits further stimulus. Overall, the U.S. economy should continue to grow at a more moderate but slowing pace from here. That said, a slower moving economy will be increasingly sensitive to shocks, whether it be a U.S. election, higher policy rates, significant geopolitical tensions, or something entirely different. Risk remain that could still push the economy into recession in 2024. After a red-hot labor market sent wages higher and brought unemployment all the way down from the height of 14.7% at the onset of the pandemic to its 50-year low of 3.5%, the labor market is now getting back to normal. Unemployment remains at 3.7% as of November, despite swift declines in job openings, and has hovered around 3.4 to 4% since December of 2021. However, cooling labor market conditions are evident in private sector wages, which have moderated from a peak of 5.9% year over year in March 2022 to 4% in November. While this is still above its long-term average, wage pressures are receding with quits falling and business reeling back hiring efforts in the face of slowing consumer demand. It's also worth noting that while strikes have made a lot of headlines in last year, less than just 6% of the private sector workforce is represented by a union, and this is down from 20% in the 1980s. On balance, we're not worried about wages contributing to higher inflation, and in the absence of a recession, unemployment should remain stable as well. U.S. businesses still face structurally slower labor force growth than in the prior decades, with the census projects showing that the population aged 18 to 64 will rise only 0.1% in 2024. Tight labor markets could encourage more immigration or further gains in labor force participation, but excess capacity may be limited. Overall, a combination of subdued job growth and slowing wages should give the Federal Reserve further confidence that inflation is sustainably coming down. Resilience in the U.S. economy has also been shared by corporate America, with earnings growth surprising to the upside last year. Revenues were the largest contributor to earnings, with consumer strength and pricing power allowing companies to boost sales. Margins, however, have detracted from earnings as companies grappled with higher input and labor costs. Still, companies have been active in defending margins by cutting costs and adopting more efficient digital capabilities, helping margins stage an impressive recovery in the third quarter. Looking at to 2024 and 2025, expectations for double-digit earnings growth seem too optimistic, as defending profit margins will become increasingly difficult in an environment of slowing economic growth and waning pricing power. However, high-quality companies with strong balance sheets, ample cash balances, and sustainable earnings should perform well relative to the broader index. After inflation reached a 50-year high in 2022, the inflation heat wave map met a cold front in 2023, with headline CPI easing to 3.1% year over year in November, well below the 9.1% peak reached in June of 2022. While this is still above the Fed's target, the underlying components of inflation provide us with confidence that the downward trend has room to run. Core goods prices trended lower in 2023 as supply chain distortions related to the pandemic and Russia's invasion of Ukraine continued to fade. Meanwhile, the more volatile components, mainly energy and food prices, also provided an important source of disinflation amidst slowing demand. Absent any supply shocks or unexpected surge in demand, these categories should continue their descent in the coming months. Lastly, shelter inflation, which accounts for a third of the CPI bucket, is predictably falling as the rollover in market rents gradually flows through the data. The remaining problem for inflation, therefore, is core services prices outside of housing, which the Fed has honed in on when referencing persistent inflation. However, as we show on the right-hand side of the slide, on slide 28, inflation in the measure is mostly just transportation services, which includes things like auto insurance, auto repair costs. Going forward, the rollover in vehicle and auto part prices should feed through to this category, and combined with easing wage pressure and cooling consumer demand, service inflation should fall further in the year ahead. Overall, inflation made impressive progress towards more normal levels in 2023. While we are not quite back to the Fed's target yet, 2% inflation in the middle of 2024 looks in reach, and this should give the Fed assurance that inflation is under control as the debate easing policy continues. The Federal Reserve has hiked rates by a cumulative 5.25% since the beginning of 2022 to combat inflation. However, with inflation steadily trending back towards their 2% target and labor market conditions easing, the July rate hike was likely the last of this cycle. At their December meeting, the Fed voted to leave the Fed funds rate unchanged at a target rate of 5.25% to 5.5%, as widely telegraphed. Forward guidance acknowledged that progress made in cooling both inflation and labor markets, but maintained a hawkish bias, likely an attempt to temper dovish market expectations. Specifically, the Fed's dot plot continued to suggest rates will remain higher for longer, with the median FOMC member expecting limited easing in 2024. However, there appears to be some diverging opinions amongst the committee pertaining to the future path of policy. Updates to the summary of economic projections reflected confidence in a soft landing scenario, and the Fed appears to acknowledge that inflation has fallen faster than expected despite economic resilience. Overall, the Fed is more likely than not to its hiking cycle, which means investors are now more interested in the timing and extent of eventual rate cuts. If the economy remains afloat, the Fed may only deliver minor policy cuts. However, the U.S. economy enters a recession, the Fed may be forced to cut rates more aggressively to try and stimulate the economy. Either way, it looks increasingly likely that rates will move lower in the years ahead, and they may still settle at a higher level compared to the previous policy easing cycles. Despite the negative headlines, the global economy proved to be more resilient than expected in 2023, but some countries clearly did better than others. The Eurozone, UK, Canada, and China struggled, while the US, Japan, and emerging markets outside of China were stronger, as evidenced by their composite PMIs remaining above 50 for much of last year. So a PMI above 50 indicates expansion, below 50 indicates contraction. In China, depressed consumer and business confidence continued to challenge growth, while the full effects of stimulus measures from policymakers have yet to materialize. China's weakness also spilled over to Europe, which is similarly experiencing weak domestic consumption and elevated manufacturer pessimism. Activity is now showing signs of stabilizing, albeit at low levels, and there is hope for a modest reacceleration in Europe as falling inflation boosts real incomes. Elsewhere, India continues to see strong growth supported by its growing middle class and government support for private business and digitalization. Global growth should be less divergent in 2024, with the US economy slowing down and China's economy stabilizing. However, the key question is how much this gap will close and whether it is more due to the US slowdown or a pickup in overseas growth. In bond markets, volatility was a defining feature for 2023 as investors grappled with resilient economic data, a hawkish Fed, and various technical factors. The yield on the 10-year Treasury climbed by nearly 170 basis points, that's 1.7%, from early April to late October before expectations for a soft landing and an end to the tightening helped drive the yields lower by more than 70 basis points in less than 2 months. Even with this move lower, current yields across the fixed income landscape still offer investors much better income and total return opportunities than existed a year ago. Slide 37 shows yields across fixed income sectors relative to the last 10 years, and nearly all sectors are trading well above their 10-year median yields. Simply sticking with core fixed income provides an attractive yield of above 5%, while leaning to riskier asset classes like high yields can provide yields north of 8%. Moreover, with peak interest rates likely behind us, bonds also offer potential for price appreciation in the event of lower rates, and diversification benefits as lower rates coincide with recessions. This potential for asymmetric return in bonds may not last long, underscoring the importance of leaning into fixed income while yields are at these elevated levels. Performance of the top 10 stocks in the S&P weight of the top 10 is an important factor too, and we expect to see some of that change in the future as well. Strong equity market performance in 2023 is not only a U.S. phenomenon, as international equities also experienced impressive growth, with the MSCI All-Country World Index climbing more than 10%. Taking a quick trip around the globe, Japanese equities had a very strong year, rising nearly 16% in dollar terms, as an improved interest rate backdrop and corporate governance reform propelled new enthusiasm for investors. Elsewhere, promising fiscal reforms and strong economic momentum bolstered the case for Indian equities, which similarly rose over 16%. In Europe, markets also saw strong performance in the first half of the year as the end of the negative interest rate supported banks and economic activity stabilized from Russia-induced energy shortages. Looking ahead, while the global growth backdrop looks set to slow, there are still strong opportunities outside of the U.S. for long-term investors and at better valuations. Indeed, international equities continue to trade at a steep discount of over 30% compared to U.S. equities, near 20-year lows. International equities also offer greater income, with dividend yields trading at 1.8% higher than yields here in the US. Combine this attractive entry point with structural tailwinds, attractive relative fundamentals, and a weakening US dollar, and the year ahead could be a much more favorable environment for US-based investors investing overseas looking to diversify and add exposure to important global secular trends and themes. Regardless of what happens to the economic backdrop, investors are still looking for consistent outcomes across alpha, income, and diversification. The challenge is that you can't get all those outcomes from the same assets. However, when you expand the opportunities set outside of the public markets, investors can leverage a range of different alternative assets to reach their desired outcomes. Indeed, as we show on slide 55 of the guide, alternative assets can offer low correlations to public markets, diversified income streams, and enhanced long-term returns. For instance, real assets shown towards the left, such as real estate, infrastructure, and transport, tend to be less correlated to a 60% stock, 40% bond portfolio, while providing robust income. Private equity and venture capital towards the right provide much higher total returns, but come with higher correlations to the public markets and little to no income generation. The classic 60%, 60-40 stock bond portfolio still looks attractive, but adding a sleeve of alternatives can help long-term investors achieve strategic goals through higher alpha, better diversification, and enhanced income. Policy tightening from the Fed has pushed yields on cash-like instruments to their most attractive levels in over a decade. With yields north of 5% minimal risk, many investors have decided to allocate more heavily to cash. However, history shows that staying parked in cash after the peak in interest rates usually leaves money on the table. In the last 6 rate hiking cycles, the U.S. aggregate bond index outperformed cash over each of the 12-month periods following the peak in CD rates, while the S&P and 60-40 stock bond portfolio outperformed in 5 of these periods. This is not to say that investors should abandon cash altogether, as liquidity is important to allocation in any portfolio. However, there is an opportunity cost in holding onto too much cash, and investors should put long-term money into long-term assets. Following a peak in interest rates, there has always been a better asset than cash to deploy the capital. So we hope you found this information helpful and informative in terms of all the happenings over the last quarter. And certainly reach out to us if you do have additional questions as it pertains to your strategy, your investment portfolio, or anything along those lines. So we wish you a great rest of your day and a great weekend. Everybody stay safe, and then we will talk to you soon.